It's Imran from Options Insight, your macro options spotlight. All right, so US indices weighed down a bit by big tech earnings. Obviously, Google and Microsoft were down best part of 10% apiece yesterday. And Europe was relatively steady, and China was bouncing pretty hard, up nearly 4% on the day on FXI, but still down pretty heavily on the week. Facebook has reported after the close yesterday and is showing down about 20%. So they missed, they had negative revenue growth and they had big losses in their metaverse division. So that stock is continuing to get battered as it has been for a while. And things don't look very rosy in the metaverse for next year. Dollar and yields also remain under pressure ahead of ECB today and the Bank of Japan tomorrow. ECB is kind of in the process of coming out. Press conference is going to be in the next 20 minutes. We'll see what they do with regards to QT and things like that. It's not really the rate hike. Everyone was expecting 75 bips, but it's more what's going to happen going forward and with their various programs, and the devil will be in the detail. Personally, I'm not overly optimistic for the European stock rally to continue that much. It's been pretty resilient recently, European stocks. So, if they do come out sort of inflation fighting and quite hawkish, I don't think that's going to be amazing for European stocks. And we'll see what happens in the euro. The euro had the bounce that we were looking for. It's not quite as high. I think it could get into that 102, 103 on a knee jerk. But I think it's running out of steam. So it probably won't be too long before the euro starts to head back down again, in my opinion. If you look at volatilities, we are seeing vol softer across the equity landscape. And pretty much drifting everywhere else as well. You see all these vols in the red. The only real thing that popped in vol was oil, up 2 vols on the day. We are seeing spot prices in crude up around 4%, recovering on US crude exports coming in higher, and diesel squeezing pretty aggressively in terms of those crack spreads and stuff, where refining margins are going through the roof again. So pretty good for the stocks if you're involved in those energy stocks. Carry wise, you can see there's not a lot of green really left there. So as implied vols have been coming down and the market's been rallying aggressively, carry's kind of been reduced across the board. The most juice does still appear to be in European stocks, but with the ECB today and with the press conference, that may well change if they induce a bit of volatility within Europe again. And then with all the data points between now and FOMC next week, we do suspect things will remain choppy. So, this carry's probably not about to improve until maybe FOMC is out the way. And then if we look at skew did bounce a little bit. You can see in Europe and US, smalls higher in that 25 delta risk reversal, but it is coming from extremely low beaten up levels, still in the low percentile ranks there. China skew also coming off. That did pop, as we said. We thought that would probably be short-lived. That's starting to come back down, as is TLT skew, still in the 90th percentile, but down about a vol point on the day as yields start to stabilize. Okay, so that's the summary for today. If we then look at what else is going on, is the melt up now consensus? Now, this is something that we mentioned in our Trader Chats episode that will be released shortly. That's something we do every quarter. We did a Q4 roundtable with the fantastic Darius Dale, Tony Greer, and Brent Kachuba of Spot Gamma. All those guys need no introduction, I'm sure. So one of the things we had talked about is, the melt up risk that's there. Is everyone too bearish? Things like that. So there's obviously been a lot of commentary recently about a short squeeze gathering pace as CTAs, commodity trading advisors, get forced back into markets because they are quite underweight. And also corporate buybacks are restarting in earnest. So is that going to put a bit of a bid underneath the market? Also, seasonality, especially into midterm elections, as Brent points out, is strong. And investor sentiment is understandably bearish after the worst year for the 60-40 portfolio since the 1930s. We do see options volumes continuing to explode, particularly for daily expiries. And S&P call volumes as a percentage of call open interest are at records, showing that fast money, hedge funds, instos are using calls to navigate these market swings, even if it's just for intraday moves. And then the extreme flattening of index skew that we've been talking about shows that investors have piled into call hedges. And you can see that here in these call volumes, and also the buyback index, which tracks, the companies that are doing the biggest buybacks. that has been kind of leading the way in terms of the rally. So people are maybe front running this buyback flow that is expected to come back. So that's all the bullish sort of arguments. Now, the problem is the mega cap techs don't seem to be playing ball, whereas you've had misses from Microsoft, Google, Facebook. You've got Apple and Amazon later today after the close. And those big FANG names are really not providing the rally fuel that the market was looking for, making this melt-up scenario a bit more challenging. All right, I'm going to focus a bit on S&P for the trade ideas for today's note. So I've said, ad nauseum how battered skew has been getting. Now, whilst the bid for calls is understandable as people need to hedge that upside tail because they're underweight, what is interesting to me is that the skew, whilst the 25 delta skew between calls and puts, which we call the risk reversal, that is at the 99th percentile or whatever. Okay, so you can see that here. I've got a chart here that looks at the difference between the 2-month 25 delta call and put. The highs were around 12 vols earlier in the year when the war kicked off in Ukraine. That has tightened all the way to around 5.5 vols, and it's it is very, very cheap on a relative basis looking back the last 18 months. Now, the interesting thing is if we were to compare if we're just to look at the put side, and we're to compare the 25 delta put to the 10 delta put. So that's the deep, deep downside, way out of the money put, and look at the spread between those. We are seeing a similar thing. So whilst that wasn't at the highs in March, that reached its highs back in December. That is now at the lows or very close to the lows at around 3.8 vols. And the lows were like 3.5. So they are also compressing that tail. And I find that interesting because I can understand why there's a relative bid for the calls if no one owns this market and they're scared of that right tail. But the reality is that we've had a lot of cross-asset volatility. We've got a lack of liquidity across markets. We're starting to see things break in FX markets, in bond markets, causing dislocations all over the place. And to me, that means there should be fatter tails on both directions priced into the vol surface. But that doesn't seem to be the case in the deep downside tail within equities, because the market seems to just be comfortable that even if equities goes down, it's not going to crash down, it's just going to go down slowly. Now, whilst that has been what's happened this year so far, I mean, we're down, whatever, we were down more than 20%. I don't remember exactly what it is on the year now. But if we were to continue to go lower, there are structural risks from downside equity derivatives barriers that we believe to be below 3,500. Okay, we're also, given the usage of one-day options or 0-day to expiry options that people are using, if market starts to roll over on whatever piece of news or bad piece of data that the market wasn't expecting, if institutions pile in and buy a load of 0 DTE puts, that's going to just exacerbate the sell-off, and that could turn what would be a 2% day into a 5% plus down day, and you could really see volatility explode. And then if that was to take out a load of downside barriers, that would just exacerbate things and you get a vol spike. So for me, that downside tail in that deep downside, that 510 delta area, should not be at its lows relative to the 25 delta put. And that's where I think there's a potential mispricing. Have a good end to the week, and I'll catch you guys tomorrow.